Hey everyone, I'm Ben Jones, CEO and founder of BA3 Accounting, and today we're diving into a topic that makes many people's eyes glaze over faster than you could say depreciation. Yes, we're talking about the balance sheet. Now, I know what you're thinking. Balance sheets? Really? Ben, come on. Can we just talk about tax write-offs instead? But trust me, the balance sheet is the unsung hero of financial statements. It's like the nutritional label of your favorite snack. Essential for understanding what's really going on under the hood. And as an auditor, we'd always start with the balance sheet because that's where the understanding would come, and auditing it would clear up a lot of questions and potential problems. So let's break it down and make it as painless as possible. A balance sheet is a snapshot of your company's financial health at a given moment in time. It's divided into three main sections: assets, liabilities, and equity. Think of it as a very sophisticated game of what you have versus what you owe, with a little what you're worth thrown in for good measure. First up, assets. These are the goodies. Everything your company owns that has value. Cash, inventory, real estate, and other things like that incredibly comfy office chair you splurged on. Assets are typically divided into current and non-current assets. Now, those current assets are like that stash of chocolate in your desk drawer, quickly accessible and meant to be used within a year. Non-current assets, on the other hand, are long-term investments. You got to think about property, equipment, or that vintage coffee machine that's going to last forever, or at least longer than a year. Next, we have liabilities. These are the not-so-fun part. What your company owes. This includes everything from short-term debts like accounts payable, which need to be paid to the electric company soon or your power gets shut off. It also has your long-term obligations like loans and mortgages that are paid off over a long period of time. If assets are the cake, liabilities are the vegetables. They are necessary, but not always that enjoyable. Lastly, we have equity. This is the dessert. Equity represents the owner's claims on the business after all the liabilities have been subtracted from your assets. It's what's left over if you would sell all your assets and pay off all your debts. Equity is also known as net worth, and it's what every business owner dreams of increasing. We like that, and the value of the company increases when you produce income and don't spend it all. The magic of the balance sheet lies in its balance, hence the name. The total of your assets should always equal or balance to the sum of your liabilities and equity. If it doesn't, well, you've got yourself a mystery worthy of Sherlock Holmes. It has to be in balance. Understanding a balance sheet isn't just for accountants. It's for anyone who wants to get a clear picture of your company's financial health. So next time you look at a balance sheet, remember, assets are your friends, liabilities are your responsibilities, and equity is your reward. And if you ever find yourself lost in the numbers, just think of me, Ben Jones, here to guide you through the labyrinth of financial statements. Happy balancing.